On January 14th, 2026, at 3:45 p.m. Eastern Standard Time yesterday, the United States Mint website appeared like a digital ghost town. Anyone attempting to purchase a Silver Eagle found that the Buy Now button had simply disappeared. It wasn't disabled. It wasn't marked out of stock. It was gone. The same thing happened with the Morgan dollar sets. The product pages remained online. The images were still visible, but the option to exchange US dollars for physical silver had been wiped from the site as if it had never existed. There was no press conference, no official announcement, just a leaked email sent to authorized distributors, which was forwarded to me around 6 p.m. last night. That email cited market volatility as the reason for suspending sales. That was it. That was the full explanation. That was the level of transparency the sovereign mint of the world, S reserve currency, believed you deserved. Meanwhile, CNBC ran a segment this morning calling it a temporary technical suspension. Bloomberg's headline read, "Mint pauses sales amid price spike. Precautionary move." They are presenting this as a responsible risk management decision, as if the mint is simply being cautious because silver moved too quickly. Here's what you need to understand right now. The screen is lying to you. The US Mint did not stop selling because prices went too high. They stopped because the silver is gone. They cannot source the metal, and as of this afternoon, the fallout is already spreading to private mints. The US Mint is only the first domino. London is already showing signs of stress. I'm a private commodities analyst. I have been stacking physical silver for 12 years. I built this channel because I got tired of waiting half a day for mainstream media to report what was already visible in vault data and futures positioning. You're not here for entertainment. You are here because you want information before it becomes consensus and before it is too late to act on it. So let me explain exactly what we are watching unfold in real time. This is a physical force majeure event. The institutional machinery that has suppressed silver prices for decades, paper shorts, fractional reserve bullion banking, and futures market manipulation, has finally collided with physical reality. When the sovereign mint of the world's reserve currency stops selling its own silver coin, the paper price becomes fiction. There's a hierarchy in a supply squeeze, and it matters. At the top are sovereign mints. They serve as the psychological anchor. When Silver Eagles are sold at spot plus $6, the market assumes supply is healthy. When sales stop entirely, that anchor is ripped from the ocean floor. At that point, the paper price, the spot price, scrolling across your screen, becomes merely a suggestion, a polite fiction with no connection to what you will actually pay when you walk into a dealer and try to buy 100 ounces. In this video, I'm going to expose backwardation. I am going to run the math on the 300 million ounce deficit that everyone in the industry is whispering about but refuses to say publicly. And I am going to show you exactly why the $90 spot price you're seeing right now is the biggest lie in modern finance. By the end, you will understand what is happening at the COMEX, what is about to unfold in London, and what I am personally doing with my own capital as exit doors begin getting welded shut. Because the reality is this: the situation is moving faster than the news cycle. If you wait for Jim Cramer to acknowledge a squeeze, you will be 3 weeks too late, staring at a 40% premium on silver rounds that cannot be delivered for 2 months. Let's get into it. As of 1:45 p.m. Eastern today, silver spot was trading at 90.38. Gold was at 4,139, 2021. Look closely at this morning's chart. You will see a long upper wick that touched 92.23 before being smashed back down to 90.38 by the afternoon. This is not natural price discovery. This is a battleground. Silver fought to stay above $92 earlier today. It wanted to break higher. Then, around mid-morning New York time, coordinated selling pressure appeared and pushed it below the psychological $90 level. I have watched this pattern for over a decade. This is what it looks like when bullion banks are desperately defending a price threshold because they know exactly what lies beyond it. Here is the divergence that should alarm you. While spot reads 90.38, authorized purchasers are reporting premiums that have gone vertical. Generic rounds are trading at roughly 1.5 times spot, if you can find them at all. Do the math. That places the real physical price closer to $135 per ounce. The screen price is a suggestion. The counter price is a hostage negotiation. And that gap between paper and physical is the smoking gun. It is the market screaming that something is fundamentally broken. Now let me explain the core mechanism driving this event. It is called backwardation. If you understand this, you will understand why the US Mint suspension is not a glitch. It is a symptom of structural failure. Backwardation occurs when immediate delivery costs more than future delivery. In a healthy commodity market, the opposite is true. Futures trade above spot because storage, insurance, and capital costs must be accounted for. That normal condition is called contango. When the market flips into backwardation, it means the future is cheaper than the present. That signals desperation for immediate supply. Buyers are willing to pay a premium today rather than wait months for settlement. Think of it this way. Imagine walking into a car dealership with an empty lot. Here is where it connects to the U.S. Mint. The Mint cannot source physical silver at paper prices to meet immediate demand. Futures say silver is $90, but suppliers are quoting $120 per ounce for near-term delivery. The Mint cannot absorb that loss. It cannot sell a silver eagle for $45 when the blank alone costs $120. So they halt sales and remove products from the website, hoping volatility subsides. But volatility is not subsiding, it is accelerating. And if you believe the U.S. Mint is the only institution running dry, wait until you see the COMEX delivery logs. Let's talk numbers. As of this morning, 36.06 million ounces, or 7,212 contracts, are standing for January delivery alone. On Tuesday, 1.3 million ounces were removed from registered COMEX vaults in a single day. That is not normal. That is not even extreme normal. That is a slow-motion bank run. Now zoom out. According to UBS and Scottsdale reports circulating within the industry, the projected global silver deficit for 2026 is 300 million ounces. That is the gap between total demand, industrial investment, and jewelry, and actual mine production plus recycling. Global annual silver production is roughly 850 million ounces. We are short by more than 1/3 of annual supply. That gap must be filled somewhere. And for years, it has been filled by draining vault inventories, COMEX vaults, LBMA vaults in London, and ETF stockpiles. Those vaults have functioned as the buffer, the pressure release valve that prevented silver prices from exploding every time demand surged. But here's the problem. Those vaults are finite. And when you keep draining them at a rate of roughly 36 million ounces per month, you reach zero far faster than most people realize. Now add the China factor. On January 1st, 2026, China introduced new export licensing requirements for refined silver. Any silver leaving China, the world's primary refining hub, now requires government approval. In effect, the tap to the West has been partially shut off. This is not a full embargo, but it is a major friction point that is constricting supply precisely when Western markets need it the most. So let's run the stress test. If COMEX deliveries continue anywhere near this pace, let S be conservative and say 30 million ounces per month. The registered vaults, meaning the vaults that are actually eligible for delivery, could reach operational zero within weeks, not months. Weeks. I want to be very precise about what operational zero means. It does not mean the vaults are literally empty. It means inventories fall below the level where the market has confidence that deliveries can be executed in an orderly manner. Once that line is crossed, you get a stampede. Traders who were content to wait for futures settlement suddenly demand delivery immediately, and the system seizes up. The math says insolvency. The skeptics say this is fantasy. We are about to find out who is right. We are roughly 60% of the way through this breakdown, so let me pause for a checkpoint recap to make sure we are aligned before moving forward. Here is what we know so far. The U.S. Mint has halted sales. Backwardation has appeared. Physical premiums over spot are signaling an urgent demand for immediate metal. 36 million ounces are being pulled from COMEX in January alone. Vault inventories are draining rapidly. However, there is a counter-argument that must be addressed. If I do not address it, you will hear it elsewhere and wonder whether I am selectively using data. The skeptic's argument is demand destruction. The theory is that at $90 per ounce, industrial users will stop consuming silver. Solar manufacturers will substitute cheaper materials. Electronics firms will redesign products to reduce silver content or replace it entirely. On the supply side, skeptics argue that at $90, scrap floods the market. Grandmothers melt down silverware, supply surges, and prices collapse back to $60. It sounds convincing because it has happened in other commodities. When oil reached $140 per barrel in 2008, demand collapsed. Driving declined, airlines failed, prices crashed. But that analogy does not hold here. First, industrial substitution in silver takes years, not days. A solar manufacturer using silver paste cannot simply flip a switch and replace it with copper-based alternatives. The product must be redesigned, factories retooled, quality testing redone, and certifications reacquired. That process takes at least 18 months, even if it starts immediately. The current price spike is happening far too fast for substitution to matter. Second, scrap supply. Yes, higher prices bring scrap to market. People will sell candlesticks and old silverware, but scrap is a one-time supply injection. You can only melt it once. It gets absorbed within weeks and does nothing to resolve a 300 million ounce structural deficit. And here is what skeptics consistently miss. $90 silver is not expensive in historical terms. Adjust the 1980 silver peak for inflation, and silver would need to exceed $200 per ounce just to match that level. We are not even halfway there. The idea that 90 is a nosebleed price that guarantees collapse, is a psychological anchor with no grounding in actual supply-demand fundamentals. Skeptics are betting on a slow fade. They expect volatility to settle, premiums to compress, the mint to resume sales, and the market to forget this episode entirely. The data is pointing in the opposite direction. The data suggests a vertical move. So what happens next? Let me walk you through the institutional responses and the indicators I'm watching closely over the next 48 to 72 hours. First, expect the CME, the Chicago Mercantile Exchange, which operates COMEX, to raise margin requirements by 25% or more this week. This is standard procedure. When volatility spikes, margin requirements increase. Long futures holders must post additional cash collateral, which forces weaker players to liquidate positions. It reduces the number of contracts standing for delivery and cools price action. I've seen this before. In 2011, during silver's run to $48, the CME raised margins 5 times in 2 weeks. It worked. Prices were cut in half. If margin hikes are announced, do not panic. This is part of the playbook. They are trying to shake holders out of positions. Second, expect minimal media coverage of the LBMA situation in London. For the past week, I have heard persistent rumors of stress in unallocated silver accounts. Unallocated silver means you own a claim, not a specific bar. It is fractional reserve bullion banking. If these rumors are accurate, the LBMA may be nearing a point where physical delivery requests cannot be honored. If London moves to cash settlement only, that is the decoupling event, the moment when paper and physical markets officially diverge. Here's my monitoring dashboard, the 3 metrics I'm watching relentlessly. Number 1, LBMA vault data. The London Bullion Market Association publishes inventory figures. If unallocated holdings fall another 10% from current levels, that is the canary in the coal mine. It signals that the fractional reserve structure is breaking and that London is scrambling to source physical metal. Number 2, the gold to silver ratio, currently around 51 to 1, meaning 51 ounces of silver by 1 ounce of gold. During silver squeezes, this ratio compresses rapidly. A move toward 40 to 1 or lower would confirm silver outperforming gold due to physical scarcity. Number 3, the premium spread. I track the gap between spot price and dealer prices. Right now, generic rounds are trading around 1.5 times spot. If that widens to 2 times spot or more, it signals that the physical market has abandoned paper pricing altogether. If London switches to cash settlement only, this is what it looks like. You request delivery of 10,000 ounces. Your broker responds that physical delivery is unavailable but offers cash at the current spot price. Spot is $90, but physical trades at $130. You lose $40 per ounce. Legally? Because your contract allows cash settlement during force majeure. That is the nightmare scenario for paper silver holders. ETFs, unallocated accounts, futures contracts not converted into physical delivery, all of it becomes monopoly money the moment COMEX or the LBMA says, here's your cash, good luck finding metal. And here is the final confirmation signal. When paper prices crash because confidence evaporates, yet physical silver still cannot be purchased for under $100 an ounce. That is when the game is over. That is when the market admits the vaults were always running on fumes and the suppression mechanism has finally collapsed. So let me tell you what I am doing with my own capital. I need to be clear. I am not a financial advisor. I'm not your financial advisor. I am someone who has watched these markets for 12 years and is now watching vaults empty in real time. What follows is my personal strategy. You must do your own research and make your own decisions. Here are the indicators I am watching and the conditional strategies tied to them. First, I'm focused on the $91.50 level with absolute precision. If silver holds above $91.50 for 3 consecutive daily closes, I treat that as confirmed breakout behavior. At that point, the technical structure shifts from a fragile rally into a sustained move higher. In that scenario, I'm looking to add exposure, but not through physical silver. Physical premiums right now are predatory. I'm not paying a 50% premium when I can gain leveraged exposure elsewhere. Specifically, I'm looking at SILJ, the Junior Silver Miners ETF. When physical silver is in backwardation while miners still trade at reasonable valuations, that is where the asymmetry exists. Miners provide operational leverage to rising silver prices without premium gouging or 2-month delivery delays. But here is the critical qualifier. I only add if the breakout is confirmed. If silver fails at $91.50 and rolls over, I do nothing. Failed breakouts are traps. I have been in this market long enough to know better than to chase a falling knife. Second scenario, the US Mint resumes sales, but silver eagles are priced at $120 or higher. If that happens, I interpret it as a new permanent price floor. It means the Mint has openly admitted the old pricing model is dead, the spot price is relevant, and physical supply and demand are now setting the market price. In that scenario, I am not selling a single ounce of my physical holdings. I am holding tighter. If the sovereign mint is selling at $120, the private market will price even higher. That signals a regime shift where physical silver becomes a strategic asset, not a speculative trade. Third scenario, the CME drastically raises margin requirements. Let's say they double margins overnight. In that case, I do absolutely nothing. I sit on my hands. I've seen this playbook before. In 2011, margin hikes forced liquidation. Prices dropped 20-30% in days. And once leveraged longs were flushed out, the trend resumed higher. If we get a margin-induced sell-off, I treat it as a gift. I wait for panic selling to exhaust itself and then add exposure. Again, likely through miners. Margin hikes impact futures traders, not equity holders. And while futures positions are being liquidated under pressure, miners can be accumulated at a discount. Margin-driven selling is artificial. It is not new supply. It is not increased mine output. It is not scrap flooding the market. It is forced liquidation, and it gets absorbed quickly. After the dust settles, nothing fundamental has changed. The deficit is still 300 million ounces. Vaults are still draining. The mint is still offline. So if silver drops from $92 to $70 on a margin hike, I'm not panicking. I'm getting aggressive. That is when most people run for the exits. And I am walking in through the side door. Fourth scenario, and this is the most important one, the LBMA confirms a physical delivery freeze. If London announces that physical delivery on unallocated accounts is suspended and cash settlement is the only option, I move entirely to self-custody and stop caring about the ticker. In practice, that means exiting ETFs, allocated storage programs, and anything involving custodians or intermediaries. I take possession. At that point, silver becomes a crisis hedge, not a trading instrument. If the paper price says $70 because the paper market collapses, but I cannot buy a coin for under $150, the spot price is meaningless. The only price that matters is replacement cost. And if replacement is impossible because there is no supply, then the metal I already hold becomes effectively priceless. The LBMA is the keystone of this entire system. London is the nerve center of the global precious metals market. More gold and silver trades through London than anywhere else on the planet. The LBMA vaults are the backstop for the Western bullion banking system. When banks hedge, when pension funds gain exposure, when refiners balance inventories, it all routes through London. If London fails, the architecture collapses. Because once London cannot deliver, the questions cascade. If London cannot deliver, can COMEX? If COMEX cannot deliver, can ETFs? And if ETFs cannot deliver, what exactly are you holding? That is when confidence evaporates and everyone rushes for the exits at once. And in a fractional reserve system, there are not enough exits. Now let me address the psychological trap I see retail investors falling into, waiting for mainstream media confirmation, thinking, if this is real, CNBC will cover it and then I'll act. That is backwards. By the time CNBC runs a segment on a silver squeeze, premiums will be triple spot and delivery will take 6 months. Mainstream financial media is structurally late. They explain what already happened. I saw the Mint website go dark yesterday. I received the distributor email last night. I reviewed COMEX data this morning. I'm telling you now. If you wait for a long-form Bloomberg article next week, the move is already behind you. The other trap is paralysis. Waiting because the situation feels complex. In a squeeze, waiting is the same as getting priced out. You may come back in a month to find prices 40% higher and premiums doubled. I am not telling you to go all in today. I'm not telling you to buy 1,000 ounces at a 50% premium. I am telling you to have a plan. Know your levels, know your indicators, know your risk tolerance, and when your conditions trigger, act decisively. For me, that trigger is $91.50 for 3 consecutive daily closes. If it happens, I add to miners. If it does not, I wait. The decision is already made. So when the moment arrives, there is no paralysis. One final scenario. And I think this one is being underpriced. If we see coordinated announcements from multiple sovereign mints within the next week, not just the US Mint, but Canada, Perth, Austria, all suspending sales due to supply constraints, that is a 5-alarm fire. That is the market admitting that the Western minting infrastructure cannot source metal. In that case, I immediately move 20% of my liquid net worth into physical silver and miners, regardless of premium. At that point, entry price no longer matters. Access does. That is positioning ahead of a structural break, not a temporary disruption. And I do not think that scenario is remote. These mints share the same global supply chain. If the US Mint cannot source blanks, neither can Canada. Perth deserves special attention. They have had credibility issues before. When they go dark, pay attention. Back in 2021, there were already warning signs. Reports surfaced that allocated silver was running thin and deliveries were being pushed back. Publicly, those claims were denied, but the extended wait times told a different story. If the Perth Mint goes dark again, that's confirmation this isn't a localized US issue. It's global. Now let me address the obvious counter-argument some of you are thinking. What if this is a false alarm? What if the Mint resumes sales next week, silver drops back to $70, and this whole thesis looks wrong? That's a fair question, and here's how I'm managing that risk. First, I'm not leveraged. Every position I'm talking about is fully paid for. No margin, no naked options, nothing that can force liquidation. If prices drop, I take a paper loss, but I stay in control. Second, this is not a binary bet. I'm not all in on silver. I still hold equities, real estate, and cash. Silver is one component of a diversified framework. If I'm wrong, it hurts, but it doesn't cripple me. Third, I have a time horizon. This isn't a week-to-week trade. I'm positioning for a multi-month, potentially multi-year move. If silver chops sideways for 3 months before resolving higher, that's fine. Structural breaks don't resolve overnight. Here's the asymmetry that keeps pulling me back. If I'm wrong, I risk maybe 20, 30%. If I'm right, the upside is 200, 300%. That skew alone justifies being positioned, even if the timing isn't perfect. I've been early before. In 2019, I started accumulating silver around $16 based on the industrial deficit and monetary tailwinds. For over a year, it went nowhere, and then dropped to $14. I looked wrong until COVID hit, then silver doubled in 4 months. Being early feels identical to being wrong, until suddenly it doesn't. The difference is risk management. You can survive being early. You cannot survive being late. Now let's talk endgames. Endgame 1, the paper market breaks. COMEX and LBMA move to cash settlement. Futures prices collapse to $60, $70, while physical trades at $150, $200. If you hold physical, you ignore the paper price. If you hold ETFs or futures, you get wiped out. Endgame 2, a true short squeeze. Bullion banks fail to source metal and are forced to cover at any price. Silver goes vertical, $90 to $200 in weeks. Miners explode higher. This would make 2011 look tame. Endgame 3, the slow grind. Mints resume sales at elevated prices. The LBMA limps along. Silver ranges between $80 and $110 while the deficit persists. This is the most likely outcome and still very profitable. In all 3 scenarios, physical silver and miners win. The only losing position is paper exposure that gets cash settled. One area the market is underestimating, industrial demand. Solar manufacturers hedge via futures. If futures fail, they're forced into the physical market. And unlike investors, industrial users can't walk away. If a factory stops, they pay whatever it takes. That demand is price inelastic and explosive. Layer on geopolitics. China controls roughly 40% of global silver refining. As of January 1st, new export licensing gives Beijing effective control over refined silver flows. This isn't accidental. It's strategic. There's no fast workaround. Refining capacity takes years to build. So here's the recap. The US Mint is dark. COMEX inventories are draining. The global deficit is near 300 million ounces. Backwardation is flashing red. China has tightened exports. Physical premiums have blown out. Paper says $90. Reality says $135. That spread is the crack in the dam. The paper wall is failing. The metal is gone. Don't wait for mainstream confirmation. By the time headlines catch up, access, not price, will be the problem. I'm watching 91.50. I'm watching LBMA data. I'm watching premiums and miners. When my indicators trigger, I act. The plan is already made. This isn't advice. It's perspective from someone who's been in this market for over a decade. Take it or leave it, but don't say you weren't warned.